Members of Congress have done it again in 2024. They outperformed the stock market, and if we look, in fact, many of them even with triple-digit returns, and it doesn't stop there. In 2023, we see more than 90% of these members outperforming, and the trend is again very similar in 2022. In fact, nearly every single one outperformed, where we do note the S&P was down around 18%, and just to show you the additional data, in 2021, we have both Democrats and Republicans continue to outperform, so this is a long-term going trend. Now, we did hear last year about President Biden talking about supporting a trading ban. However, right now, Donald Trump is going to be taking on power, so it will be interesting to see whether or not this actually gets passed, or if in fact members of Congress will be allowed to continue to massively outperform the S&P. Now, we have taken a look at Democrats and Republicans at their latest buys in January this year to understand whether or not we can get some very similar performances, and we've taken a look to understand what are the main stocks that they have been buying, and we're taking a look at 8 of them today. We're going to run it through our own valuation as well to understand if we believe right now we should be adding. Now, stock number 1 is Amazon, which is up 46% over the last 12 months, and over the last 10 years, it has massively outperformed the S&P 500, up 1,327%. We can also see trading at the upper end of the 52-week range, and that hasn't stopped members of Congress who continue to buy. In fact, Wall Street themselves give this a strong buy rating, seeking alpha with the buy, and even though Quant do give this a hold at 3.49, it is not far off the 3.5 to flip this into a buy rating. We also want to run through the growth grade of each of these companies. Are they actually looking to grow over the longer term in comparison to the sector? Well, their revenue for Amazon up 12% over the last year, forward looking around 11%, a lot better than the sector comparatives at 2 and 3% respectively. And the one key takeaway is their earnings per share expected to grow at 22% over the next 3 to 5 years, when in comparison we do notice the sector at around 10.4, and this is a company that over the next 4 quarters they're expecting double-digit growth to the EPS on a year-on-year comparative, and over the last 4 quarters they have outperformed quite significantly. That is a 100% track record. So if we do look at their December 2025 EPS estimate, that means right now Amazon is trading at a forward P of 36.1. Now, as we said, for each one of these companies, we are going to run them through the valuation model, and for Amazon, we get an intrinsic value of $253, which has derived from the DCF model. Now, we're not going to show you every company as we want to run through 8, but we'll show you the first one where we have the free cash flow year on year. Average growth rate is skewed as they had a couple of years of negative free cash flow. Moving forwards, we've gone for 20%. As you can see, that is a low rate, although we have the different rates and the attributable value here. Based on the 20% with a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, 253, which actually based on this gives it upside of 13%. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any others. But we'll show you for full transparency, at 25%, this does give an intrinsic value of $342, that's upside of 53%, and at the 30%, for those that are a lot more optimistic, $460 thereabouts, indicating 106%, that is more than a double from the current price. So we want to be extra conservative and go for the 20% moving forwards, and it doesn't stop there, as we do always like to apply a margin of safety. We execute on the 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for Amazon, a buy at around $227, and then we keep going till it's near the current trading price, not at the 15% level just yet. So right now, if you are buying this alongside members of Congress who are very bullish, as well as the strong buy rating from Wall Street, you're getting at least a 10% MOS, with the price target at the end of the year at $254, indicating 14% upside. And do give us your thoughts as we go along these 8 stocks today. We then move on to General Electric, GE, which is up 41% over the last year. Over the last 10 years, however, it is down around 8%, and it is similar to Amazon, trading at the upper end of the 52-week range. We do notice the strong buy rating from Wall Street, that of what we saw for Amazon, and this one, unlike Amazon, does pay a yield, although on the low end of 0.63%. In terms of growth, looking as impressive with the A+, year on year, that is very large, 64% versus 4 for the comparative. However, over the next 12 months, they are expecting a dip of 20%. In comparison, this sector is anticipated to grow at 5.2, but we do quite like the earnings per share, estimated 30.5% over the next 3 to 5 years, with a comparison at 11.4. Similar to what we saw for Amazon, green right across the board, so growth over the next 4 as well as the 4 out of 4 beat. And if we look at their earnings per share for this year, the current forward PE does sit around 34.3. So what about the valuation of this company? Well, we actually get to $186, which indicates, based on the current price, there is no margin of safety. But for those that do want to consider this company at 10%, we'd see that around 167, at 15% around 158, and at 20% around 149. Some people, however, do like to buy companies around the fair price, and Wall Street, with the strong buy rating, they actually see more upside than Amazon, 27% with their price target at $228. We also want to let you know we do release one free article every single Monday morning where we talk about severely undervalued stocks for your attention, as well as what's gone on in the market over the last few days. So if you click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information, the upside that Wall Street themselves see over the next year, as well as a recently released copy of 43 stocks that Wall Street believe right now have the most upside in the S&P 500. So click below, you can sign up and read straight away. We then move on to stock number 3, Broadcom, up more than 100% over the last year. Over the last 10 years, more than 2,000%, massively outperforming the S&P. We do see it at the upper end of the 52-week range. Another strong buy rating from Wall Street, and do note both Seeking Alpha and Quant not far off the 3.5 to flip this into a buy, with a yield now sitting just above the 1% point. In terms of growth, they get a B, although looking very good, 44% over the last 12 months, 25 anticipated over the next 12, and we can see well above the mid-single digit from the sector comparative, and the earnings per share expected to be fairly strong, 22% versus 15.4. Not only green across the board, but we do see the double-digit growth over the next 4 quarters anticipated, 100% track record, and based on October 2026, $7.64 earnings per share, the forward P is slightly under 30 at 29.85. When we get to the valuation, again, similar to other companies we've looked at today, we do believe Broadcom right now is trading in line with its fair value. But again, for those that want to see at 10%, a buy at 205, at 15 around 194, and at the 20% 182. And again, you can always grab a copy and play around with these numbers, whether it's for Broadcom or any others. But what we do notice, Wall Street see this company at $265 over the next year, translating to 16% upside, yet members of Congress are very bullish. Do they know something that we don't? We then move on to stock number 4, Adobe, which is down 30% over the last 10 years, though again massively outperforming the S&P, up 450%. Trading at its 52-week lows with a double buy from Seeking Alpha as well as Wall Street. This one doesn't currently pay a dividend, and they do have a D+ on growth, although we notice year on year and over the next 12 months expected growth of 10%, with the sector median coming in at the mid-single digit point. In terms of the EPS, pretty much bang on the same for the sector comparative, 15 versus 15.4, and we do love the fact that over the next 4 quarters, double-digit growth is anticipated with a 100% historical track record. If we look to November 2026, based on the EPS, the forward P does sit around 18.1. In terms of the valuation itself, at $586, we actually get quite a substantial margin of safety for this company today. And as we keep going, not the 30% level just yet, you are getting at least 25%, although you could argue between 25 and 30, with Wall Street themselves very, very bullish. They see a price target just under $600 with upside of 42%, and maybe this one could be a bit clearer as to why members of Congress are buying. Stock number 5, we have Applied Materials, up 16% over the last year, up 614 over the last 10, massive outperformance again, trading at the lower end of the 52-week range, with a double buy from Seeking Alpha and Wall Street, a yield just below 1%, and we do get a slightly poor growth grade at C-, low single-digit growth year on year, mid-single over the next 12 months, which isn't too far off the sector median on both accounts. But we do also note the earnings per share is expected to come under 11.3, with the comparative at 15.4. Again, green right across the board, always great to see this, and based on the October 2026 EPS, the forward P sits just above 17 at 17.08. Valuation at $252, again another one with maybe a more attractive margin of safety, not at the 30% level just yet, actually not very far off, so for Applied Materials, AMAT between 25 to 30%, with Wall Street fairly bullish, $215 price target, 19% upside expected by the end of 2025. We then move on to Nvidia, up 142% over the last 10 years, up 25,000%, in fact higher, massively outperforming the S&P at the upper end of the 52-week range. A strong buy from Wall Street, although again quant not far off a buy rating, with a yield on the very low end at 0.03%. If we take a look, growth very impressive, triple digit over the last 12 months in comparison to the 4.4, 94% expected over the next 12, again significantly higher than the low single of the sector, and the EPS expected 38% with a comparative at 15.4, and no surprises to anyone, they are anticipating double-digit growth to the EPS over the next 4, with 4 out of 4 beats. In terms of the forward P, based on January 2026, it does currently sit at 30.7, and the valuation, we get to $180 today, and if we do take a look at the margin of safety, pretty much at least 20%, not at the 25 just yet, somewhere between 20 to 25, with Wall Street very bullish, their price target alongside their strong buy rating at $178, indicating 30% upside at the end of the year. We then move on to the dividend king, Johnson & Johnson, down 10% over the last year. Over the last 10 years, up only 40%, trading towards its 52-week lows, with a double buy from Seeking Alpha and Wall Street, one of the higher yields today at 3.43%. And if we do look at growth, they actually get one of the worst with an F rating. Over the last 12 months, 5% under the sector at 7.6, a drop of 1% over the next 12 with a comparative at 7.6, and we also notice the EPS coming in very low, 5.7 versus 10.6. Also worth pointing, they only anticipate one of the next 4 quarters to be growth, however they do have a 100% historical track record, and based on the 1064 EPS, the current forward PE does sit at 13.6. Intrinsically though, we get $174, and as we do see, you could argue a fairly attractive margin of safety, not at 20% just yet, sitting between 15 to 20. They have been increasing those dividends for more than 50 years now, and Wall Street also fairly bullish, 20% upside, their price target $174, and as always, do give us your thoughts in the comments below. We then move on to stock number 8, Microsoft, up 9% over the last year, massively outperforming again the S&P, up 804 over the last 10. In the mid to lower end of the 52-week range, a strong buy from Wall Street with a buy from Seeking Alpha, and a yield currently sitting at 0.8%. In terms of growth, well, they get a C-, although we do notice both on a year-on-year and a forward-looking a lot better than the sector comparatives, and we can also see the earnings per share over the next 3 to 5 years may be surprising for this Mag 7 company at 13.3 when the sector comparative sits at 15.4. No surprise though, green right across the board, as we said, 100% track record, positive growth to the EPS year on year, and based on their June 2026 EPS, the forward P does sit around the 28.4 mark. In terms of intrinsic value at $495, you are getting a 10% MOS at 15%, pretty much a buy at $420, not far off, so somewhere between 10 to 15%, with Wall Street themselves giving this $506 price target, upside of 18. As always, give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter and grab those spreadsheets, and also come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.